if you have been watching your monthly expenses climb while your income stays the same, you already understand the pressure that millions of Canadians are navigating right now. Food costs more, housing costs more, and the gap between what retirement income provides and what daily life actually demands has widened significantly over the past few years. That context matters because what is happening with the Canada Pension Plan in 2026 is a direct response to exactly that reality, and for a large number of Canadians, it translates into an additional $1,350 over the course of the year landing in their payments. That figure is not a one-time check, not a special relief payment, and not something separate from your regular pension. It is the combined result of two distinct forces working at the same time. The first is the annual cost of living adjustment, which recalibrates CPP payments each year based on changes in the Consumer Price Index. The second is the continued rollout of the CPP Enhancement, specifically the second additional tier that the federal government began phasing in, and which is now producing a meaningful and visible difference in payment amounts for people who contributed at the right earnings levels during their working years. Together, these two components add up to the increase that is hitting accounts in 2026, and understanding how each one works puts you in a much stronger position to verify that you are receiving everything you are entitled to. The CPP enhancement itself began as a long-term reform designed to address a fundamental limitation in how the original plan was structured. For decades, the Canada Pension Plan was built to replace roughly 1/4 of a person's average work earnings. That proportion was set at a time when workplace pensions, personal savings, and other income sources were expected to fill the remaining gap. As those alternative sources became less reliable and less universal, the adequacy of the original replacement rate came under serious scrutiny. The enhancement introduced a higher replacement target, phased in gradually through increased contribution rates and expanded earnings ceilings. Workers and employers have been contributing at those higher levels for several years, and 2026 represents a point in that phase-in where the benefits are substantial enough to make a real difference in retirement income. The earnings ceiling piece of this is worth spending some time on because it directly determines how much of the enhancement you are eligible to receive. The year's maximum pensionable earnings figure is the income ceiling up to which CPP contributions are calculated in any given year. If your employment income in a particular year reached or exceeded that ceiling, you made full contributions for that year and built maximum entitlement for that period. The enhancement introduced a second, higher earnings ceiling, and contributions on earnings between the first and second ceiling feed into a separate tier of benefits. If your salary during your working years regularly pushed into that upper band, you are positioned to receive the fuller version of the 2026 increase. The way to confirm this is through your Statement of Contributions, which is accessible through your My Service Canada account online. That statement is arguably the most important document in your retirement planning toolkit, and it is one that a large proportion of Canadians have never looked at carefully. It shows every year of your contributory period, the earnings recorded for you in each of those years, and the contribution amounts associated with them. Errors in that record are not as rare as you might expect. Employers occasionally report income incorrectly, administrative processing mistakes occur, and the transition to the enhanced contribution framework introduced additional complexity. If your statement shows earnings in a particular year that do not match your recollection or your tax records, that discrepancy is worth investigating because it directly affects the benefit calculation that determines your monthly payment. The contributory period itself is a concept that shapes your CPP entitlement in ways that surprise many people. It runs from the month you turn 18 to the month you begin receiving your pension. Every month within that window is either a month where you contributed, a month where you were exempt for a qualifying reason, or a month of zero contribution that can pull your calculated average downward. The system does include provisions to drop out a percentage of your lowest earning months from the calculation, which softens the impact of periods when you were between jobs, studying, or earning very little. But the dropout provision only helps so much, and understanding what your actual contributory record looks like gives you the information you need to have an informed conversation with Service Canada if something appears incorrect. One of the most underutilized provisions in the entire CPP framework is the child rearing dropout. This applies to parents who reduced their workforce participation or stopped working entirely to care for children under the age of 7. Those years, which often correspond to some of the lowest recorded earnings in a person's contributory period, can be excluded from the calculation used to determine your average pensionable earnings. When low-earning years are removed from that average, the average rises, and a higher average produces a higher monthly benefit. The critical point is that this provision does not apply automatically in every case. You need to confirm that it has been applied to your file, and if it has not, you can request that Service Canada review your record and apply the dropout where it is warranted. For anyone who took several years away from the workforce to raise children and is now finding their CPP payment lower than expected, this is the first place to look. The age at which you begin your pension is another dimension of the 2026 changes that deserves careful thought. CPP can be started as early as 60 or as late as 70, and the monthly amount you receive is permanently adjusted based on that start date. Beginning before 65 results in a reduction applied to every payment for the rest of your life. Waiting beyond 65 results in a permanent increase, with the enhancement for each month of deferral adding up to a substantially larger annual income for those who can afford to wait. The 2026 enhancement amplifies this dynamic because the base amount being adjusted upward or downward by the age factor is larger than it has ever been. Someone turning 70 in 2026, who contributed at the maximum level throughout their working years, is looking at a monthly payment that reflects both the enhanced contribution framework and the full deferral bonus, and that combination produces numbers that are genuinely transformative compared to what the pre-enhancement CPP would have provided. The decision about when to start your pension is one of the most consequential financial choices in retirement planning, and it does not have a universal right answer. Your health, your other income sources, your housing situation, and your personal priorities all factor into it. What the 2026 numbers make clear is that the financial case for waiting, where waiting is a realistic option, has grown stronger. If you are within a few years of your planned start date and have not recently modeled out the payment amounts at different starting ages using your actual contribution history, doing that analysis now with current figures is time well spent. For Canadians who are already receiving CPP and are also continuing to work, there is an additional mechanism called the post-retirement benefit that functions alongside the main pension. Each year that you work and make CPP contributions while already receiving your pension Those contributions generate a separate, additional benefit that gets added to your monthly payments the following year. The rates associated with the post-retirement benefit have also been updated for 2026 as part of the broader enhancement framework. If you are in this situation, you are effectively building a small additional layer of pension income with each year of continued work, and the 2026 adjustments make that accumulation more valuable than in previous years. Taxation is an aspect of the CPP increase that requires some forward planning. The additional income from a higher monthly payment is taxable, and depending on your total retirement income from all sources, a meaningful increase in your CPP could shift your tax position. For some recipients, the increase might push total income into a range where it affects the calculation of other income-tested benefits. It is worth having a clear picture of your full income profile before assuming that every additional dollar from CPP translates directly into a net gain. Working through the tax implications, either independently or with a financial or tax professional, ensures that you are not surprised by a larger than expected tax bill at year-end, and that you are making informed decisions about optional tax withholding on your pension payments. Old Age Security operates separately from CPP, and while they are both federal retirement income programs, the rules governing each are distinct. CPP is based on your contribution history, and the 2026 enhancement flows from that contributions-based structure. OAS is based on residency and is subject to a recovery tax for higher income recipients, sometimes referred to as a clawback. It is important not to conflate the two programs when assessing the impact of income changes, because an increase in your CPP does not trigger the same type of recovery mechanism that applies to OAS. However, since both are included in your total taxable income, understanding how they interact within your overall financial picture remains relevant. Service Canada manages the administration of CPP, and while the system processes the majority of payments accurately, it is not infallible. The combination of a multi-decade contributory record, multiple legislative changes to the plan's structure, employer reporting processes, and the complexity introduced by the enhancement framework creates conditions where errors can occur. If your payment amount seems lower than you would expect based on your working history, or if your statement of contributions contains years with earnings that do not reflect what you actually made, the appropriate response is to request a formal review. Service Canada can examine your file, cross-reference it with CRA tax records, and make corrections where the data supports them. That process takes time, but the financial impact of a corrected calculation can be significant, particularly over a retirement that may span 2 or 3 decades. The practical starting point for all of this is your My Service Canada account. If you do not have one set up, creating one is the first concrete action worth taking. Once you are in, pulling up your statement of contributions and reviewing it against your memory of your working years gives you a baseline for everything else. From there, confirming that applicable dropout provisions are on file, checking the earnings figures recorded for years when you are at or near the maximum pensionable earnings ceiling, and verifying your personal and banking details are all straightforward steps that collectively ensure the system has accurate information to work with. The Canada Pension Plan in 2026 is more generous than it has ever been, and that increased generosity is the product of years of contributions made specifically to fund these higher benefits. The $1,350 annual increase that eligible Canadians are seeing is not an arbitrary gift from the government. It is the return on contributions that workers and their employers made under a framework explicitly designed to deliver higher retirement income. Making sure your records are accurate, your eligible provisions are applied, and your start date decision is informed by current figures is how you ensure that the investment you made throughout your working life pays you back fully.